Geoff Lewis, global market strategist with JPMorgan Asset Management, joins us live from Hong Kong. Geoff, good morning. Thank you for joining us. Geoff, Ukraine is clearly on the front page once again. Money managers are still bothered about China, but the minute I look at stock prices, looks like Ukraine is history, and no one seems to acknowledge the problem in China because most of the major markets are trading with a positive bias. How come there is no nervousness in the system because of Ukraine?
Well, I think Ukraine is something which people can't control, and it's going to be with us for some time. But I think investors are just assuming that common sense will prevail, and although it looks like Crimea will migrate to Russia after a vote, as long as Ukraine itself, as long as Russia respects its territorial integrity and doesn't try and take some of the eastern regions, then I think possibly we can work our way out of this crisis. Although sanctions, if they come in, they may not actually help. They may escalate the tensions somewhat.
Geoff, what's the sense that you're getting about the dollar index in particular first, and how that is likely to pan out amidst all this uncertainty and stories with China as well as Crimea, which is still playing out?
Well, I think if there is a deterioration in the Ukraine situation, then clearly the dollar as the safe haven will tend to benefit, and so also will U.S. Treasuries. That's usually what happens when there is a crisis of this sort, some kind of geopolitical shock. But let's keep our fingers crossed and hope that that can be avoided. Otherwise, we think the dollar will probably be on a firming trend in the second half of this year.
Geoff, but as we speak, the dollar index is way below 80. It is at 79.35. Even though of late the US economic data is strong, the factory production data which came last night was rather impressive. How come there is no excitement in the dollar index or in the US currency?
Well, I think the US economic trajectory is pretty well discounted. The temporary severe winter weather that disrupted in the first quarter, I think we're now through that, and the numbers are picking up a little bit. So there isn't really anything new, I think, and we're still quite a long way from the time when the Fed will start actually raising short-term rates, and US long-term yields have come down. So it's not surprising, I think, that the dollar is relatively stable or just slightly weak at the moment, but we do think it will strengthen somewhat later in the year.
Geoff, in India, money managers are surprised, some are foxed, but everyone is asking the same question, that have Indian markets in the short term run slightly ahead of themselves, and how much of the current market action in India is a function of Modi?
Well, I think Modi is obviously a very big influence on the stock market, and whether that is now basically in the price, I suspect as the election draws near, it will actually run a little bit further. Clearly, investors are really hoping that there will be a change in government in India and a more business-friendly, reform-minded administration led by a BJP coalition. That is the dream outcome for investors, both domestic and foreign. Whether that actually materializes, we'll have to wait and see. So I still think there's quite a bit of risk there.
Geoff, what's the sense that you're getting about the FOMC meet this week, and what really is going to come about?
Well, I think the bar is very high for Yellen going back on tapering or pausing. So I think we will see further tapering in line with 10 billion reduction in large-scale asset purchases, treasuries and mortgage-backed securities. And the Fed will continue its course because the labor market is showing some signs of tightening, and the numbers are improving. So the underlying trend in the U.S. economy is still about 3% in our opinion. So I think there's little reason at this stage for the Fed to do anything other than stick to its course and switch from QE to forward guidance as the main instrument of monetary policy.
So, Geoff, to your mind, what will influence the script of how emerging markets will move in the short term? Ukraine, China, or US Fed?
Well, I think probably all of those things, but I think it's what we're seeing is there's still a lot of nervousness about emerging markets. I think some of the institutions are nibbling, even in the debt space. So it's the retail investors that are still particularly wary, but I don't see a big catalyst. There's still quite a lot of adverse political news, and really the economic numbers have not been brilliant either. So I don't see a great deal of excitement in the emerging market space in the short term, although valuations are very cheap.